Ian Fleming said a quote that impacted me the first time I heard it, and I say it every day ever since I've heard it. The quote goes, "The loss is always bigger to the loser than the win is to the winner." The winner. Another good quote is, "Slow and steady wins the race." These are two quotes that dictate how I trade. Today, I'm going to show you why dollar cost averaging is actually better than trying to catch the perfect pump on a meme coin that is supposedly going. Let me start off by saying, first of all, this is not financial advice. So do with all this information whatever you want, but I am not your investment banker, so I do not know your current financial situation. This is just what I am doing in my opinions. Second of all, you hear many people talking about, many investors online, many money gurus talking about how, oh, well, I invested my 401k this way. Oh, I took my grandma's house, I listed it on Zillow, and then I sold it, but I didn't actually give the person the house, so I still had the house, but I also had the money. Then I sold my grandma's dog, and then I took my mom's house, refinanced it, and opened credit cards in her name, just so that I could put more money into my 401k. You hear all these things about financial advice and you about investing, but in regards to crypto, there's no one way to do it really. And the reason is because crypto is really just too new. Now, crypto has been around since 2009, Bitcoin has, but it really hasn't exploded until the past couple of years. Now, I say past couple of years, but even back 2016 till now, almost 10 years ago, yes, Bitcoin has gone up, but the amounts it has gone up is like we've never seen before. What you're looking at the screen right now is an investment calculator, and I'm going to be showing you the power of dollar cost averaging. But there is one thing I must get clear, and that is that Bitcoin, its annual returns are a little all over the place. So, what do I mean by this? Last year, the annual return for Bitcoin was 150.9%. Over the last 5 years, it's 63%. Over the last 10 years, it's 86.7%. So Bitcoin is kind of all over the place in regards for its annual return. But in this case, we're going to be looking at just a 6% return. Actually, let's match it to what the S&P 500 is, and a 12% return. So this calculator is going to show us why dollar cost averaging is better. So we're starting with $1,000 in our account, which is a pretty reasonable amount to have. If you don't have it, don't fret. And how long we're going to be doing it? Let's say over 10 years. Let's say you're 30 and you're going to be doing it until you're 40. You're 40 and you're going to be doing it until you're 50. Or you're 50 and you're going to be doing it till you're dead. Hopefully you make it to the end of the 10 years. Now, it's going to be compounding annually, and we'll be putting in $500 a month. Some of you can't afford this, some of you can, but this is simply just something I would be doing. So then you hit calculate. Now, it's going to show you right here this little chart, and it shows you what exactly, how much you put in, how much you started out with. And you can see here that 47% of our end balance of $114,000, 47% of that is interest, meaning our investments actually went up, so we paid in and then it went up. Now, 53% is what we have paid in. So yes, we've still paid in more than the interest, but 47% is not bad. You can see that our total contributions are $60,000, but our total interest, or the money we got back simply from buying the crypto, is $53,000. So that is the power of compounding. Just from $1,000, starting off with $1,000 and then $500 a month, you can get to $114,000 at a simple 12% return rate. Now, I told you that Bitcoin was having 150% return rate last year. Overall, it had over the past 5 years, it's 63%. So obviously, it's significantly higher than this. But just to be safe, this is what the S&P 500 returns, which is the stock market, and so we're just matching it to that for this example. So $114,000, and all you had to do was click buy. You didn't have to sit at the charts. You didn't have to look for the perfect timing. You didn't have to try and draw your little lines, do your little matching. Okay, so this candle means this. No, all you had to do was invest, work your job, invest, start a business, invest. So this is why I believe in the power of dollar cost averaging. Just a set amount over a set period of time rather than a certain amount at one time, hoping it goes up. Because the loss is always bigger to the loser than the win is to the winner. If someone came to you and said, hey, would give you $114,000, all you had to do was wait X amount of time. Or they came to you and they said, hey, I'll give you $114,000, but you have to roll the die and it has to land on a 5. If it doesn't land on a 5, you don't get any money. And in order to get this roll, you have to pay $1,000. You have to pay $1,000 to roll the die, and if you don't get your 5, then you lose your $1,000. Now, it's tempting to roll the die. Don't get me wrong. I've rolled the die. I lost money, which is why I believe that dollar cost averaging is the best way to go. Now, is it wrong or is it bad to roll the die? No, I have done it. I've rolled the die. I've bought coins like Dog with Hat. I've bought coins like SHIB. I've bought coins that I'd rather not say I bought, but I've bought tons of meme coins, and I used to be a meme coin addict, if I'm being completely honest. But then I realized that meme coins are more of a gamble. Now, I still buy meme coins, and they go up more than likely they're going to go down, but I buy them with the gambler's mindset. I say, this is some spare change that I'm willing to throw at a coin, hoping it goes up, hoping I don't get rug pulled. So, all that being said, remember, the loss is always bigger to the loser than the win is to the winner. And slow and steady wins the race. That being said, I will see you in the next video. Adios.